before 11:15. So before we start today's webinar, I would like to direct your attention to the chat box where you can see there's a link to a SurveyMonkey link. Sorry, please help us to complete the survey. It will only take you a few minutes so that we know where we can improve on to serve you better. Okay, it's 11:15 now. Morning to everyone. Welcome to today's webinar. So for today's webinar, we will be presenting on a company initiation on Health Management International, HMI, which we have initiated coverage on last week. Then we'll proceed to talk about company results on Geo Energy Resources, which announced their results last week. So then subsequently, we'll also be providing a sector update on the Singapore property market, as there were some measures that was being announced by MAS last week. So without further ado, HMI. Our title for this company initiation would be Heading for Another Leg Up. So a brief snapshot on HMI. It closed at 63 cents and a half last Friday, and our target price is at 83 cents with a buy rating. As you can see, we actually took a snapshot of the stock price performance of HMI as compared to the FTSE Healthcare Index. The FTSE Healthcare Index is being rebased, and as you can see that we compare its performance over the past 1 year. HMI has obviously outperformed the healthcare index in this sense. So our thesis for our buy call on HMI mainly boils down to four main points. The first one would be the most important one, which is the expansion pipeline set for the next 3 years. And these expansion plans would eventually drive revenue to grow at 11.5% CAGR over the next 5 years. Then we'll subsequently talk about the second one, which is on their superior EBITDA and EBIT margins as compared to its peers, which we think is sustainable, and we think that it's still growing on improving economies of scale. The third one would be on exceptional track record, which showcase the HMI's management's core expertise in hospital management, and is still enjoying its first mover advantage. The fourth one will be on its recent corporate development. which is on consolidation of the ownership of its 2 hospitals. So before we move on to talk more about the investment thesis, let's take a look at the company's background. So HMI's key assets will comprise of 2 tertiary hospitals in Malaysia. One would be the Mahkota Medical Center, MMC, which is located in Malacca. It has 288 bed capacity, and the other one would be at Regency Specialist Hospital, which is located in Johor, and it has 218 bed capacity. So moving on, I will be referring this as the Malacca Hospital, and this as the Johor Hospital to avoid confusion. These 2 hospitals, as shown in the picture here, this is the MMC, and this is the Malacca Hospital, and this is the Johor Hospital. These 2 hospitals are being supported by a network of 17 patient referral centers across the region, mainly targeted at the Indonesia side. HMI also owns and operates the HMI Institute of Health Sciences. So HMI IHS is located in Singapore, somewhere near the Jurong East, IMM area. So this Institute of Health Sciences mainly provide trainings for nurses, as well as some medical assistants and medical officers. So to give you a brief outlook on where the hospitals are situated and its competition landscape around the area. This is a map of Malacca. As you know that where MMC is located is somewhere around the Mahkota, somewhere around the ferry port of Malacca, and is quite near to Malacca International Airport as well, which given it that an edge on attracting medical tourists. So about 60 to 70% of its patients are actually foreign patients. So as you can see that in vicinity, Mahkota Medical Center is basically the dominant player given its huge bed capacity, as well as it being one of the earliest hospital that moved into Malacca. Subsequently, let's take a look at the Johor Hospital. So number 4 here is the Regency Specialist Hospital. Yes, it's quite far away from Iskandar side, but at the east side is basically an industrial area. So, and this industrial area is still developing, meaning that RSH, the Johor Hospital of HMI, is actually consists more of corporate clients. About 70% of its patients are actually corporate clients. And yes, we can see that there's a pipeline of new hospitals, be it public or private hospitals, are actually constructing and is on the way. But we do not deem this, we still think that the investment thesis for the Johor Hospital for HMI remains intact, because considering that these new hospitals will need at least 2 to 3 years for construction. And as you can see that there's a huge bed capacity for each of the hospitals, and usually for a new hospital, they are being launched after it has been after its construction has been completed. It would not jump straight away by providing the full bed capacity. It will go to open up its bed capacity by stages. So probably 50 to 100 beds for the first year, then subsequently it will increase. So with this, we think that for all these hospitals to reach its full bed capacity, it will take up another 5 to 7 years. So this will give the Johor Hospital Regency about at least 9 to 11 years head start. Next, we take a look at the map of the 17 patient referral centers, which is supporting its 2 hospitals. So as you can see that majorly its centers are located in Indonesia side, and they have one in Cambodia as well. So before I move on into our first key investment thesis, let's take a look at how a private hospital built in Malaysia looks like. So healthcare is heavily regulated in Malaysia. They have made it compulsory for all the hospitals to itemize each of the items under the hospital bills. And as you can see, it's being divided into 2 different segments. The first one will be hospital charges, which includes admin fees, the bed fees, lab, diagnostic test fees. Then the second part will be the doctor's charges, mainly the consultant fee and the procedures fees. So doctor's charges goes to the doctor, and as for hospital charges goes to HMI. Mainly this is, sorry, let me backtrack a bit. So how does this actually works? Because HMI is adopting a business model that is somewhat similar to Mount E, Gleneagles, which they sell or rent out medical suites to medical consultants. So basically, these doctors are considered as independent practitioner for HMI. HMI does not pay employers or doctors fees. So the revenue to doctors mainly comes from doctors' charges. However, having said that, the doctors' charges are being kept under the Private Healthcare Facilities and Services Act in Malaysia. So what does this mean? It actually gives a ceiling to what the doctors can charge on its consultant's fee, as well as on its procedures fee, including the surgical costs. This is very different from what Singapore is seeing in our healthcare landscape. So in Singapore, basically all the prices are transparent and it's not regulated. So it's based on market pricing, where you'll be able to you can just Google up and do some research on Ministry of Healthcare, where all the prices are being listed out. You can take a look at what's the average price is like before you consult a doctor. But in Malaysia, all these are being stated into the Malaysian law. So by that, they cannot simply just raise prices. However, all this, having said that, doctors' charges are being kept, but the hospital charges are not. So basically, this means that the private hospitals will be able to charge higher than the public hospitals. And given that the more advanced medical equipment that they possess and they provide, they will be able to charge even higher diagnostic charge or lab test charge. So these are the margins drivers for HMIs. So let's move on to our first investment thesis on why do we have a buy call on HMI. HMI is going to increase its total operational bed by end of this year, which is the first half of their financial year of 2018. So this 15% increase consists of a new ward of 30 operational beds to each of the Malacca and Johor hospitals. Secondly, they will also add another hospital extension block at the Johor hospital by financial year 2020. So the Johor hospital is basically half the size of the current Malacca hospital. So because the Johor hospital has been running on full capacity, they would expand. Let me backtrack. So they will like to increase their existing capacity by doubling it in terms of area, meaning that including medical clinics, including wards, including their operating theatres, and so forth. As for MMC, their Malacca hospitals, currently there are still some room where they are currently looking at to renovate, so they can convert some of the free space into wards as well. So after fully utilizing all the free spaces, the next prospective expansion in the long term for HMI could be a new hospital extension for MMC. So, however, having said that, even with these two expansion plans being laid out, we expect that the top line will grow at 11.5% CAGR over the next 5 years. So, how is expanding a hospital will be able to boost its top line and bottom line? Then we have to go into reviewing on what is basically its revenue contributor and the factors behind it. So as you can see from the charts on the right-hand panel, their key revenue contributor are basically hospital services, which contributes about 98% of its top line. And we list out 4 factors that are actually boosting its top line as well as its bottom line. So the first one will be number of patients. Secondly, number of specialist consultants. Thirdly, range of services and facilities. And the last one will be average bill size per patient. So these 4 factors actually interlink with each other. So as you know that number of patients would drive revenue. The number of as for number of specialist consultants and range of services and facilities are the key factors that would attract or draw patients and affect the average bill size per patient. So higher average bill size per patient will depends on the number of complex cases being treated in the hospitals and the utilization of its services and facilities. So let's delve into each of these factors one by one. The first one will be on the demand itself. So we think that there are favorable social demographics environment in Malaysia that will support the growing demand for quality healthcare. So as according to IMF, that Malaysia will be facing an aging population by 2030. And the life expectancy for Malaysia is still increasing as you can compare against the more developed countries. We also see that there are growing spending power in Malaysia, and Malaysia is still below global average healthcare spending, and we think that it will pick up as the economy grows. Subsequently, we look into the supply of healthcare. We think that the healthcare provision remains undersupplied as compared to its developed countries in terms of the bed capacity, which is hospital beds per 1,000 people, its healthcare workforce per population as well. All these indicators suggest that it's still undersupplied. Sorry. Thirdly, we also see that there's a increasing access to healthcare and medical insurance, which would encourage patients to transition from public to private healthcare services. So as you can see from these two charts itself, the number of policies for medical insurance and the premium for healthcare insurance are actually growing. So this indicate that there's a rising awareness on the value of healthcare insurance among the growing affluent consumers in Malaysia. Next, as mentioned just now, that access to specialists and subspecialist services actually helps to draw patient volume as well as lift average bill size. Inpatient bill is the main driver for hospital services revenue growth. So if we break down to inpatient and outpatient, as you can see that the inpatient load might look small in this light blue bar, but it contributes 98% of the total revenue from hospital services. So if we look into 2012, average inpatient bill size is at about 16 times of average outpatient bill. But as HMI's services and subspecialists grew, as of 2016, we see that the average inpatient bill size is about 38 times of average outpatient bill size. So this further show that inpatient bill is the main driver for HMI. So for the next 5 years, we expect that there will be a continuous growth in patient load at 7.7% CAGR, and based on the increasing capacity, increasing or expanding facilities and services as well, we also think that the average bill size will increase by 9% CAGR over these 5 years. The third factor that we think that would support patient demand would be the growing medical tourism. So medical tourism is actually a lucrative business because foreign patients tend to seek more intensive and costly treatment compared to local patients. For HMI's case, the average bill size for foreign patients is actually at 1.5 times of an average bill size of a local patient. And as you can see that from here, HMI actually has quite a significant market share at about 10% in Malaysia's medical tourism market. And it has maintained quite a consistent mix at about 21% of its total patients load being a foreign patient. So this favorable patient mix also helps it to support its high average hospital bill size. And we continue to deem this as favorable, and we think that they will continue to draw foreign patient demand because of its strategic location and being supported by the network of 17 regional patient representative offices. So other than its own effort, the Malaysian government is also doing marketing and promotion efforts in Indonesia as well. And they are also improving flight and land connectivity, which could spur medical tourism in Malaysia. So in particular, here I would like to touch on some of the prospects in Malacca. The first one will be on Malacca Gateway, which the government is expecting to complete by 2025. And the other one would be on expansion of Malacca International Airport. So by completion of this project, the government actually expect there will be an additional of 2.5 million tourists additional tourists to come in to add into the tourism market. So we think that HMI would definitely benefit from medical tourism, especially in its Malacca hospital. Next, the improving and sustainable superior EBITDA margin compared to local peers. So as mentioned just now, that what makes HMI different and why it could demand such a high EBITDA margin or a high average hospital bill size per patient is because of its ability to handle complex and surgical cases, its advanced medical and diagnostic equipment, and its ability to handle critical care cases and emergency cases. All this actually helps to lift average hospital bill size. So as you can see from here, HMI's hospitals EBITDA margin actually outperformed in last financial year, as compared to the Malaysia average. Malaysia average, we only look into KPJ and IHH hospitals businesses, and the others selected peers would include its regional peers in Singapore as well as Australia side. And we think that given its superior margins, we think that this improving trend is sustainable, and we think that is going to continue to improve in the near term, which is because of mainly because of the Johor's hospital. As Johor's hospital just turned profitable in FY14, as you can see here in the chart, it broke even in 2013 and it turned profitable in 2014. From here onwards, the margin has been going up and catching up with the Malacca hospitals. The Malacca's hospitals has an EBITDA margin of about 27, and the Johor one is only at about 20, giving an average for the group at about 25. We think that it will continue to improve considering the scalability of the two hospitals. Next, we'll touch a bit on HMI's core expertise in hospital management. As you know that HMI actually acquired both its hospitals at loss-making condition, and its ability to and it managed to turn around MMC in 2 to 3 years, and the Johor hospitals in 5 years. This is actually very impressive record that reflects the good hospital management by HMI's management. And they have actually gained some first mover advantage, which also reflect the good foresight of HMI's management. Firstly, they are the early mover in medical tourism, and as you can see that it has been proven by its market share in foreign patients or medical tourism in Malaysia. The second one would be it is one of the 2 hospital groups which are being approved by Singapore Ministry of Health for usage of MediSave in Malaysia. So this would be a value proposition for Singapore who would just who could just cross over the border and visit the Johor hospital. And the cost is actually 1/3 of what you are looking at in Singapore. Thirdly, is independent clinic model. As mentioned just now, they sell or rent out medical suites to medical consultants, to doctors. So this model itself is unique in Malaysia, and it appeals to the doctors. It also helps them to retain these independent practitioner, mainly in the specialists or subspecialists. Last but not least, it has a very strong brand equity. It has it was being awarded a total of 18 awards, and these are a testament to HMI's quality service and excellent management as well. Last but not least, we move on to look into the recent corporate development of HMI, which is the consolidation of its 2 hospitals' ownerships. This would mainly cut the leakage to the non-controlling interest. So in last year's November, HMI announced that they are going to consolidate its Melaka and Johor hospital to full ownership each. And the total consideration would be about 560 million. 38% will be funded via cash, and the rest will be paid by issuance of new shares. So the cash will be mainly funded via debt facility, and the new shares are priced at 57 cents per share and subjected to 1-year lockup period. They target to complete this transaction by end of March, meaning this month. So this is a chart where you can compare to its pre-transaction structure and the post-transaction transaction structure. So you'll be seeing that sorry, they will cut off the leakage from here, and this would actually move up and they will own they will have 100% control over the marriage. They will have 100% control over the operations or operating profits as well. We deem this transaction as favorable because this transaction is 30.4% accretive on a financial year 2016 fully diluted EPS pro forma basis. Next, we'll talk a bit about our assumptions, which will derive our valuations price at 83 cents. So firstly, we assume that they will maintain the occupancy rate at about 70% over the next 5 years. Then we take into consideration of their near-term growth, which is the new wards in each of the hospitals. And we think that this could support about 10% growth in net revenue from hospital services. And in the medium-term growth, the new hospital extension block in their Johor hospital, which is targeted to be completed by 2020, we think that the impact will only be kicked in by 2021. So these two would translate to 11.5% CAGR to its top line over the next 5 years. Then we look into the costs. its key operating expenses will basically comprises its staff costs and the cost of services. So these two forms about 80% of the group's total expenses. And as you can see from here, the orange line here, this is the staff cost, and you can see that over the past 3 years, it has maintained quite stable at about 20% of its 20% of HMI's revenue. So this is a percentage of revenue. And on its effective cost management, and we think that there are room for improvement in economies of scale. We think that EBITDA and the net margin should continue to improve over the 5 years. We also assume that the cash conversion cycle should remain the same as per last financial year. Although there's we can see that there's an improving cash conversion cycle. Last but not least, we think that the financial position would remain strong. The main key capex coming on would be for the new hospital extension block in the Johor Hospital, which would take at least about 160 million. We expect that it's going to be spread over 2.5 years and will be funded via a mix of debt and internal cash resources. So as of last financial year, HMI is at a net cash position of 37 million. So this also provides plenty of headroom for its expansion. Then a snapshot on our DCF valuation. So from here, we actually took a 7% weighted average cost, and we assume perpetual growth of 1%, which we would arrive at 83 cents valuation for HMI. And we took the most recent foreign exchange rate, which is 1 Sing dollar to 32 ringgit cents. So as you can see that over the past 9 years, ringgit has been weakening over Sing dollar. We took the last cross rate for Sing dollar and Malaysia as our base case, but a weakening ringgit against Sing dollar basically is a double-edged sword for HMI. It would increase its price competitiveness, especially for medical tourists to its hospital, but it would also depress the SGD denominated stock price. So HMI is actually currently trading at about 56 times of its trailing PR. This is more than 1 standard deviation higher from its 5-year average. But having said that, it is quite comparable to its Malaysian peers at 54 times, although it's at a 27% premium to its regional peers at 44 times. So move on to our last slides on investment risk. So for HMI, as mentioned in our very early presentation, we mentioned that there will be an intensifying competition, mainly coming from its Johor side. But because of the very high startup costs, we think that there's a medium barrier to entry. Secondly, it will be a risk of margin compression arising from rising operating expenses, as well as a regulation of changes in regulation of healthcare costs and tariffs. Thirdly, will be the foreign exchange risk, which we have mentioned just now. So just to recap, we initiated on the HMI with a buy call and a target price of 83 cents. Next, I would like to pass the presentation to Guang Zi, who will update you guys on the results.
Hi, good morning. It's Guangzi here. Here is the Geo Energy Resources results update on of last year. So our title is modules are ready to be settled. So Geo Energy Resources held the analyst briefing on last Monday, and it announced its annual results on 2 weeks ago. So we maintain our buy call with unchanged target price of 45 cents, and its last close price was 28.5 cents on last Friday. So here is the results. As you can see that all the results, the P&L in FY16 is incomparable to FY15 because in FY16 Geo actually started to produce coal and sell it mainly to Chinese market. So the most important update was the potential restructuring of medium-term note. So as of December FY16, Geo was carrying the MTM with face value at 100 million Singapore dollars, which will be expired in January 2018. So the management gave the guidance of the potential solutions on this restructuring, but not limited to the following. The first one was the Geo could possibly issue another new bond to repay the MTM. The second was it could also extend the MTM. The third one is it will partially pay back the MTM and roll over the remaining amount. So it is expected that the update will be in 2 to 3 months from now. So if the company does not have any updates, possibly it will leave the MTM expired and they will pay back the full amount in January next year. The next is that the company will plan to expand the sales in Indonesian market. So in terms of the geographic breakdown in FY16, 78.5% of the total sales went to China market, and then followed by the Indian market, which took up around 11% of the total sales. So for the Indonesian domestic market, it only contributed 7.1% of the sales volume. So moving forward, the company will try to explore the opportunity to supply the thermal coal directly to the power plants through the PLN. So in that case, it can increase the profit margin moving forward. The next is that Geo will maintain its cash cost at around 26 US dollars per ton in this year based on their sales target of 10 million tons. So the last thing is the recap, which we already stated last week. So this year, the central government of China will cut more than 170 million tons of coal production capacity. So it is expected that the coal price will be stabilized at the current level, which is around $40 per ton as of 4.2 thousand thermal coal. So next I will pass to Paul to talk about the update on.
Sorry, Lindsay here. Apologies that both our property sector analysts and REIT analysts aren't around today, but they have actually published a report to update on the recent measures being announced by MS. You can refer to their updated report in our website. So I'll just briefly take you through what have been announced last Friday afternoon. So mainly there were three key measures being announced. Firstly, is a TDSR relaxation for homeowners with 50% equity in their home but not able to gear further. This mainly affects owners looking for home equity loans. Secondly, is the more significant cut in seller stamp duty. So this cuts the SSD from 4 to 3 years and reduces the rate by 4% points across all tiers. This is the most meaningful measures as it could stir some investor interest, especially foreign buyers. Thirdly, would be the new stamp duty for property holdings entities, which are companies that hold 50% assets of residential properties. This measure is to close a loophole in duties between sale of physical properties and corporate shareholdings in properties. This is a negative measure as it will affect bulk sale of properties and even planned privatization of listed property companies. So the conclusion of all three measures are at best perhaps stimulate some demand that were waiting on the sidelines. This is because the key ABSD and TDSR policies have not been changed. These three measures provide little to support mass market demand. Hence, they have not changed the target price for the respective stocks under our coverage. We have a neutral rating on Singapore property market, and this is actually a table that tabulates the companies that's under our coverage, and just to reiterate, we have not changed any of our discount rates to our RNAV estimates, and as well as hence the target price. Sorry. So we have come to the end of our webinar. We shall open the floor to questions. If you have any questions, please feel free to type into the question box. And at the same time, please kindly help us to complete the survey provided by the link in your chat box. This would help us to improve our service, the content itself, which you could feedback on how we can improve to serve you better. Thank you. The survey link is actually at the chat box. So if you go to your go to the webinar right-hand panel, then you'll find there's this header called chat. You just expand it. There are a Survey Monkey link to our survey. There's a question on HMI's price over NAV. So let me move you to bring your attention to the peers comparison. As you know that HMI currently doesn't own 100% of both of these hospitals. So likely that after the consolidation, this would bring it down to as comparable to its Malaysian peers. And as for its dividend yield, yes, it's actually at 0.35 cents because it doesn't have a dividend policy and it doesn't usually pay dividend to its shareholders, but it does pay to its non-controlling interest. So after the consolidation itself, we think that HMI will start paying to its shareholders, which would include the current non-controlling interest as well. So our assumption takes into consideration of 20% payout ratio to its earnings. If there's no further questions, we shall end our today's webinar. Thank you for tuning in and hope to see you again next week. Thank you.